management has been given funds to invest. So the question that we have is, how can we measure how efficient management is with the funds that they've been given to invest? So think about these funds as the difference between equity and debt. So, we give the shareholder, we give the management team equity to start the business, and we give the lenders give them debt, and they put that capital together. They invest in plants, they invest in people, process, technology. All of that stuff comes together. They sell their product, they get a return on it, and the question is, how efficient are they, and how can we measure that efficiency? And one of the ways to do that is through a metric called return on invested capital. So that's what we want to talk about tonight, and that's why it's important. It's really about management efficiency. So let's talk then about now I know this is like a formula, right? So don't let your eyes glaze over, because we're really going to boil this down here in a few minutes. So return on invested capital formula is net operating profit after tax divided by total invested capital. You probably are saying to yourself, I am no better off now than I was about 5 minutes ago, because that is a complicated formula. Well, let's take it maybe a piece at a time. Let's go to the next one. Net operating profit after tax, otherwise known as NOPAT, is, and you can read that formula, but at the end of the day, on the income statement, there are returns related to operations. So you've got operating revenue, operating expenses, and so the expenses and the income on the income statement that are related to operations is what this is talking about. There are other things like other income and things like that aren't included in this. So it's really the net operating profit, and then you basically back down the taxes. So it's the after-tax operating profit of the business. So it's really that simple. The denominator in this formula is invested capital. That's also a little bit interesting, because you go after fixed assets and non-cash working capital. That's really all there is. So fixed assets are the property, plant, and equipment, trucks, and even leases that the company has that are capitalized. So those are the fixed assets. And then you go after the things that are considered working capital. And I can see your eyes glazing over as I keep talking. But working capital are basically your current assets minus the current liabilities. So the calculation called return on invested capital excludes cash. So we want to take our cash and back it out of that equation. So now that we've gone through the technical definitions of this, maybe we could kind of do an example that would be a lot more fun and a lot less technical. So can we boil this down? Absolutely we can. We're going to start a business, and we're going to start a lemonade stand. I don't know if you guys ever did a lemonade stand, or if you've seen kids do a lemonade stand, but they basically get some lemonade. They or their parents actually make the lemonade up. They put a little sign together and get some chairs, and they sell lemonade. So that's the business that we're starting. We're starting a lemonade stand, and we're doing it with $100. And that $100, $50 of that comes from you. You are starting this business, so you are donating $50 to that business, and then your parents are loaning you $50. So that is the $100 that you have. So if you want to think about this between equity and debt, the equity is the $50 you put in to the lemonade stand, and the debt is the $50 your parents put in, because you're going to have to pay them back at some point. So your $100 is debt and equity. So here we go. Let's go. So I put together a fake income statement and balance sheet related to the lemonade stand. And if you look at this closely, you'll see that. Let's start at the bottom with the income statement. So this is after the period that you actually sell your lemonade, right? So you sold $30 worth of lemonade, and it cost $10. And so your before tax profit is $20. So the cost of $10 is the lemonade mix and the sugar and the water and whatever cups, that kind of thing. So then your before tax profit is $20. and I use 25% for taxes, and it was really just because it made the numbers easier. So we ended up with a net income after tax, net operating profit after tax of $15. So now let's go to the balance sheet. The balance sheet says, hey, I've got cash now of $40. I got accounts receivable of 10. I've got fixed assets. Now the fixed assets are $70, and that's made up of the materials it took to build your lemonade stand. Oh, and let me back up and talk about accounts receivable, because your buddy Bobby, I don't know if you got a buddy Bobby, but if your buddy Bobby came down and wanted some lemonade, he didn't have any cash. He says, "Hey, buddy, I'll pay you back later." He owes you $10 for the lemonade, so he's got to pay up. If he doesn't, if he stiffs you for the lemonade, you're going to have to write that off. It's going to go against your NOPAT. But for right now, he owes you $10. You got fixed assets of 70. You to build your stand, you took a card, a Lowe's charge card, and you bought some things at Lowe's for $5. You still owe Lowe's for that. You obviously still owe your parents $50, and now you have equity of $65. So you say, wait, I put 50 in. Where does the 65 come from? As the owner, guess who gets the profit? You do. So the $50 plus the $15 in net income comes to you as the owner. So you now have $65 in equity. So how do we calculate return on invested capital with this? We take the $15, which is the return. $15 is return. The invested capital is the fixed assets of $70 plus the accounts receivable of 10 minus the accounts payable of 5 gets you invested capital $75. $15 divided by $75 is a return on invested capital of 20%. So I tried to make that as simple as I could. Hopefully that worked out pretty well. But then the question is, why? Why does it matter? So what return on invested capital is it examines how a company utilizes its capital to invest and grow further in the future. But there are some caveats. One of those caveats is it is only one metric, and it may not give you a complete story of the company. Also, there are some sectors like utilities and REITs who are capital intensive. They have a lot of capital on their books, and therefore they tend to have lower results when it comes to return on invested capital. And then sometimes companies with low return on invested capitals can potentially improve efficiency with new management. So if you see a company with low return on invested capital and the board makes a change in the CEO or the leadership team in some way, you look at that and you go, wow, there is a lot of room here to improve the efficiency of this business. If this new management team can pull it off, it may be a great investment for the future. So those are ways to kind of utilize return on invested capital. But lastly, just to keep in mind, it doesn't really make a big difference, but it ignores intangible assets like goodwill. So if you got a business that is a merger and acquisition type of business that has tons and tons of goodwill, you may want to keep an eye on that as part of this calculation, because it does not include things like that.